Good morning, everybody. Thanks so much for joining us today. We are so glad to have you with us. I am kind of letting some folks in from the waiting room at this time. So, as folks are joining us, I thought I'd go over some housekeeping before we get started. My name's Ashley Barger. I'm with Centurion Technologies. I'm helping put the webinar on today. So, I'm going to kind of be the hostess with the mostest. I just wanted to make sure everybody knew that this is being recorded so we can share it after today's presentation. So if you do not wish to have your video on for the recording, please go ahead and disable that now. That's in the bottom left corner of your Zoom screen options. Additionally, please utilize the chat feature at any time. Ask questions. I will ensure that those questions are answered. I may interrupt the presenter to make sure that they are, or we'll save them for the end, and I will make sure at the end those questions are answered. All participants today will receive a follow-up email, and that will include contact information, the presentation materials, as well as the kind of roundup of all the questions and answers that we go through today. So I'll keep track of those. I'll also include a link to download the video recording for you. Okay, so at this time, I wanted to kind of introduce Centurion Technologies for everybody. I'm not sure who all knows Centurion Technologies, but they are full service, everything you can think of in the energy industry for your commercial or industrial business. And we have with us today Craig Kuchbaugh. He is the owner, the end-all be-all with everything Centurion Technologies. So I thought maybe he could introduce himself today. Craig, if you would unmute yourself and say hello.
Good morning, everyone. Thank you all very much for joining us. We look forward to providing you some information about the market and the impact of the Inflation Reduction Act. Scott Ameduri, our business partner, has done a wonderful job with this for over 15 years. Centurion Technologies has been in the energy business for over 20. So thanks for joining us. Any questions, please ask.
Thank you, Craig. And without further ado, we're going to get started. I know Scott has a lot of information to share today. He's going to go pretty quickly through his presentation material. So without further ado, Scott, thank you so much for being here. And thank you so much for bringing to the forefront everything that Enerlogics provides, especially in partnership with Centurion Technologies.
Great. Thanks, Ashley. Everybody, nice to meet you. There's a lot of information here, as Ashley and Craig mentioned. We are a partner of Centurion's, and we are a solar developer, solar energy storage and other energy assets that we've developed. A little bit about who we are as a company, and then I'll kind of dive into a lot more of the meat of the presentation. We are, as I said, a full service developer. We've done a heavy amount of solar and energy storage across the country. Initial focus on Ohio projects with Kent State University, with Penn Career Center, with the City of Brooklyn, everything from ground mount to rooftop systems. We're deploying canopy, carport canopy systems, and heavy on batteries in the West Coast and with Marine Clean Energy. I got a solar plus battery portfolio we're working on with the City of Ann Arbor as well. But we have a tremendous amount of development experience and look at things very holistically from an energy perspective. Whether it's energy efficiency, whether it's demand response, whether it's just straight, solar and energy storage, those are all things that are in our wheelhouse and things that we look at to drive the most value for a variety of customer segments. Our process is a multi-step process as we go through development, really kind of starting left to right, but with a virtual design analysis, getting kind of indicative pricing together into more of the final design and costing into the deployment phase. But again, we are working always hand in hand with our customers and user facilities to kind of make sure that the value proposition of the project meets their needs and meets the needs overall. A little level set on what we're going to talk about today. Kind of really four main areas here that we're going to just level set on. Number one is, where is the project located? Right now, this presentation is focused heavily on behind the meter projects. meaning that they are on-site solar, on-site energy storage projects designed to offset what that facility uses from the grid. In contrast, front of the meter or utility scale projects really have similar impacts from the Inflation Reduction Act, but they'll do it a little different way. So again, our focus is really on-premise or behind the meter kinds of projects. On the technology side, we're focused in on solar and energy storage, but other clean energy technologies, wind, clean hydro, even hydrogen-based stuff are all going to have similar kind of benefits. Again, our focus is really on solar and energy storage because that's where we see the fastest deployments happening. Thirdly, a lot of the information here is based on current interpretations of what the likely Treasury guidance is going to be around the IRA. It is not yet finalized. So Treasury is currently in a public comment period. I believe it ends the Friday on the public comment period. So we expect we'll have official Treasury guidance in 60 to 90 days. But right now, this is all based on current interpretations of the law, not on exact guidance from Treasury. Lastly, we're not a tax advisor, just standard disclaimer. We're giving you guys our experience on this, our review of it, our discussions with multiple different legal counsels on it. But as always, consult your tax advisor for anything that affects you directly. Again, as we kind of look at that and peel a bit more into those deployments or where things are at, we're squarely talking about sort of the left two sides of it, on-site solar and the community solar side of it. We're not talking about the utility scale, the financial PPA kind of structures on the right. Again, our focus is really heavily on-site, on-prem activities. As we look at solar and energy storage, kind of look at sort of three main drivers that are all coming together very strongly at this point in time to drive this. Number one is rising electricity costs. So everywhere in the country, electricity costs are rising and continuing to rise. In regulated states, we're seeing 15–18% cost increases year over year, and those are being filed for now as we go through the different cycles. That's partly driven on inflation, partly driven on just the higher natural gas cost coming out of the Ukraine Russia issue. But at the end of the day, electricity costs are rising and expected to continue to rise. Driver number two we see heavily is sustainability goals. So ESG, carbon footprint reduction, kind of whatever your buzzword is around that, that is a driver for everything from public sector to private sector clients. We are seeing that as a heavy focus, particularly as public companies are going to be forced to put more and more of that reporting together as part of their compliance reports. And then lastly, the IRA, what we're going to talk about today, has a huge amount of tax benefits that are all coming together very well to drive faster and better economics around projects. So we'll peel into these a little bit. Obviously, the third category there, the tax benefits, is what we're focusing in on today. Kind of a quick look of electricity prices on where we're seeing the trends. 2021 and 2022, this is all information from the Department of Energy's Energy Information Administration, EIA. But EIA basically said in 2021, year over year, fastest rise in electricity rates since 2008. So we're already at sort of 20-year-ish highs. If we look at 2022 forecast for this winter in particular, wholesale prices are expected to be 20 to 60% higher than average this winter. So again, driven heavily on natural gas pricing, wholesale pricing is going to be higher. They're forecasting an 8% rise in 2020 or 2022 will be an 8% rise over 2021. Again, on a regulated side, but this is a challenge for everybody from an operations and planning perspective. How do you plan when you don't know your price cost? You need to kind of get some certainty to it. Solar and energy storage really helps around that side of it. So again, our approach always is know where you're at. And again, highly recommend, always understand what your energy usage looks like and what your cost profile looks like. So understand enough on your tariff. And that's something that we can certainly help you guys and your customers as you go to market to understand where you're at, because understanding where you're at is really critical to how we address that and drive costs down. Generally, solar and energy storage are sized for only a portion of facility usage. We're looking at where you have available roof, ground, and parking lot areas. Energy storage, we're going to size around critical load and demand management. But basically, all these are really designed to kind of work in concert with net metering, which is essentially where we're able to net your usage against the generation of the solar, and we're able to offset sort of your usage and use the grid as a sense as a battery. Every state has some variability on net metering, so we have to kind of know where facilities are located at. Again, all this is available to you guys. Don't want to belabor this point, but our focus is behind the meter. Behind the meter assets, or behind the meter solar and energy storage, reduces not just your supply cost of energy, but also your T&D, or transmission delivery of that energy as well. That second big category is ESG. Scope 1, Scope 2, Scope 3 are the buzzwords on the EPA reporting side in terms of your emissions. Scope 1 is basically direct facility activity. Scope 2 is where we come into play. That's upstream activity that includes electricity. Scope 3 includes the transmission and distribution of that. But on-site solar really kind of impacts both your Scope 2 and Scope 3 emissions. And again, using solar to do that gives you the ability to do it. Our suggestion is know where you're at. Again, with benchmarking, EPA has a really good resource called eGrid that lets you put in, high-level facility information, where it's located at, how much electricity you use, how much natural gas you use, and comes up with those calculations of your carbon footprint. And then we can layer in solar and energy storage to help you manage that. We look at on-site solar really for a cost savings and a Scope 2, Scope 3 emissions reduction. We can look at offsite solar as well for some of that to address the balance of your Scope 2. So if we don't have enough facility room, if you don't have enough roof to get to max out 100% of your energy consumption, then we would look at a combination strategy of both on-site for as much as we can, offsite or wind for the balance to kind of get you wholly there. Lastly, RECs. So RECs always come into display, but renewable energy credits. There is a liquid market in certain states that RECs can be utilized and purchased to kind of offset some of that. We look at that sort of as the last stage in that, really looking at electricity with the combined solar and generation and RECs as a better strategy, but RECs is a fallback to kind of balance out some of your other gaps in the carbon footprint. I'm going to dive into the IRA, but kind of let's level set some highlights of it. So the Inflation Reduction Act is now 2 months old. It really kind of has some really big changes from where we were pre-IRA. Number one is it puts a 10-year horizon of full value credits for onshore offshore wind, for solar, for storage, for hydrogen, and other clean technologies. It has both a PTC, or a production tax credit, and an ITC, or an investment tax credit. They are kind of defined for certain technologies now, and then they go into a technology neutral credit starting in 2025. Full value of the credits is tied heavily to prevailing wage and apprenticeship requirements. Again, we'll talk about all this later in detail. There are bonuses available for domestic content. There are direct pay options that are available for certain technologies on one side, and then also for certain entities that are going to be the users or the owners of that system on the other. There is some transferability of that. Sales of the tax credits happen not under direct pay, but under some of the other ones. And again, it keeps the accelerated depreciation in there for clean energy projects. Kind of putting this a little bit together here, and again, we'll hit all those areas pretty keenly. The full 30% investment tax credit has either a size restriction or sort of size minimum, or some prevailing wage. So if we're under a megawatt of solar, you automatically qualify for the full 30% ITC. If you're over a megawatt, now is where the prevailing wage apprenticeship requirements kick in. So either you meet prevailing wage, or we have a narrow window that you can start construction less than 60 days after Treasury guidance is issued. Again, that's a limited window for new projects. It's one of the things we're looking at for some of ours to kind of take the advantage of a little lower cost without the prevailing wage and apprenticeship requirements, but the Treasury guidance not yet issued, so we've got some time there. IRA does bring in a brand new energy storage credit for standalone storage, minimum 5 kilowatt hour capacity. So that means now any energy storage project qualifies for its own tax credit, independent of having to pair that with solar. Pre-IRA, I had to pair that with solar. Now I can do that by itself and make that qualify for the tax credits. The domestic content bonus kicks in if you have 100% domestic steel and you have a minimum of 40% of equipment costs from US manufacturers. That minimum threshold steps up slightly over time, but basically, it does have a higher ITC if we can get to the domestic content. Really, this is an if, because right now there's so few suppliers of modules and inverters in particular for the solar side. Batteries is a whole nother story. But there's not enough US suppliers to really get there yet. But I think that's going to continue to grow over time. Again, all of us on the development side are competing for the same US suppliers, and there's just not enough supply yet. There are bonus language in there that's really dependent on project location, but a 10% tax credit bonus for qualified energy community or brownfield. There's a 10% bonus for low income areas, and those can be stacked. So there's ability to get more and more of the tax credits. And then lastly, there's a direct pay option for tax exempt facilities. So any tax exempt facilities can now get a cash payment for the tax credits that they could not get formerly. So again, if a tax exempt facility was owning a solar array pre-IRA, that tax credit got stranded. Now this brings this back in where they can get a direct pay for it, similar to the old 1603 cash grant days. Again, kind of looking at this at a high level, some examples from ACP or American Clean Power. They looked at, again, kind of where these are at, but on the investment tax credit level, the base credit, if you don't have the size or the prevailing wage, would be 6%. When you kind of look at where we are for most projects, a 30% investment tax credit. If you had that domestic content or energy community bonus, it takes you to 40. If you had, a couple of those, now you get it to 50%. But we're looking as much as, in theory, up to 70% tax credits against projects, ideally sited with domestic content, in the right location, can get up that high. On the production tax credit side, it looks at this on a 10-year horizon, but you can also take a production tax credit. That's an annual tax credit for the initial 10-year operating period. Most projects in our experience are going to go with the ITC. Again, the ITC and the PTC, why they're different, what they are. The investment tax credit was set to step down from the current 26% down to 22% and then 10% thereafter. With the IRA, this steps back up to 30% with the size and prevailing wage requirements. You can either elect a one-time investment tax credit based on the project cost or a fair market value approach, or you can take a production tax credit. That's a tax credit based on the energy production of the system over the initial 10 years. Again, our experience is behind the meter projects generally best served with an ITC. Standalone energy storage only qualifies for the ITC. It's harder to kind of quantify the production side of an energy storage system. We've seen some data sets from a variety of folks in the industry that's saying, roughly utility scale under a certain cost will likely be more economically served with the production tax credit. But again, for most of what we're doing, especially when we're talking about behind the meter, it's going to be ITC focused only. As we dive into the ITC, the base rate, it starts with a 30% tax credit. Really, it's written as a 6% tax credit basis with an additional 24% if you meet those labor requirements. We kind of bundle it together with everybody else in the industry and call it a 30% tax credit. Those tax credits are really driven on some of the apprenticeship requirements as well to get to the full 30%. There are bonus credits for, like we said, everything from domestic content to low income, qualified energy communities, et cetera. And there is some specific carve out around tax exempt bonds. So facilities that are financed by tax exempt bonds does have some reduction in tax credits, just something to be aware of. We haven't seen much tax exempt bond financing yet on projects, but we certainly expect as a direct pay option comes in there that will start to come into play more and more. So we're continuing to watch that as well. Apologies for that chart, very small, but SCIA published a good information on what these tax credits look like at a high level. Again, this is kind of looking at the bonus, but basically under a megawatt project, we're at 30% tax credit sort of throughout the time of it. As we get into more and more larger projects over a megawatt, is where we have that sort of threshold. So over a megawatt after 60 days, 60 days after the Treasury guidance is issued, it's a base ITC of 30%. If you don't meet the prevailing wage, if you do, now you're back up to 6 plus 24, gets you to 30%. And that's kind of how the language is written that way. It's sort of backwards way of writing about it, but it does get us there. Again, there are bonuses in there for domestic content, for low income, et cetera, and we'll talk about those a bit more as we get into this. We look at energy storage. So standalone energy storage is now eligible for the tax credits. Essentially, the floor on that is a 5 kilowatt hour of storage capacity. And up gets us there. It's for new standalone energy storage projects placed in service basically January 1, 2023 or later, as long as we start sort of that construction, in the next couple of years. Modification of existing storage is eligible. You can kind of read what's there, but basically if we increase the nameplate capacity of an existing storage project, now that storage project can become tax credit eligible. This converts to a tech neutral storage credit a few years down the road. But it does give us, a really good option for adding energy storage to newer and existing solar, something that we couldn't do as cleanly before. There is a tech neutral tax credit, so that starts in 2025. As we kind of see the visibility on this, it converts from really defined technologies, solar, wind, onshore and offshore, and energy storage into a tech neutral one. This is, I guess I'd say, a little bit of a punt by the folks that put together the language that lets us not pick winners and losers, but see what the industry kind of develops. But anything that kind of has some reduction in carbon emissions, clean technologies, perhaps a nuke, will start to fall under the tech neutral tax credits. But basically, it should look very similar for solar and energy storage for that 10-year horizon, but new technologies will come into play in a few years as well.
Hey, Scott.
Yeah.
I did have a question come in from one of our participants. It's regarding prevailing wage. It says that you have to use prevailing wage for 5 years after a project, but what measures prevailing wage if construction is done?
Yeah, so good timing. This slide right here addresses that. So the prevailing wage requirement is on both construction and alteration or repair. Right now, current guidance is likely that will include O&M. So operations and maintenance of that facility will likely fall under that requirement for prevailing wage. So we expect there's probably going to be a slight bump in O&M cost, particularly for any on-site work that would happen as a result of that. And again, the prevailing wage requirement is only for projects greater than a megawatt AC. So call it bigger than 1.25 megawatts DC. But larger projects are going to have that requirement. Smaller projects do not have to fall under the prevailing wage. Again, there's a window here on that prevailing wage and apprenticeship requirements that we have 60 days after Treasury guidance is issued. Treasury's in comment period right now, so call it 90 to 120 days from now. If we start construction or safe harbor in that time period, we don't have to meet prevailing wage. If we start construction after that, then you definitely do if you're bigger than a megawatt. Okay, tax credits. There are some cure language in there in terms of fines and things like that. If you don't meet prevailing wage, you have the ability to kind of get back to full 30% tax credits. I believe it's sort of a certain dollar amount per worker that you fell short on prevailing wage. Yeah, so here's more of the language on that one. So on the prevailing wage side, it is required for 5 years after facility is placed in service that any of that repair, alteration, or really kind of construction methodology. Again, I think as we see Treasury guidance, it may not fall under full O&M, but if I'm on site fixing stuff, it's pretty clear that it will. If I'm on site just inspecting as part of normal operations, that may not necessarily have to be prevailing wage. There is, as I said, language in there for cure. If you didn't meet the prevailing wage, you can pay some penalties around it to get back up to the prevailing wage ITC threshold. On the apprenticeship side, it's driven, again, really kind of fostering this industry more, but ensuring that there is the next generation of that through the apprenticeship requirements. And there's some specific language in there on number of hours. And again, that's for both the construction phase and 5 years after the 5 years after the facility is placed in service. Let's see. Again, kind of looking at what the thresholds are for the labor requirements, just to make sure we're on the same page. Threshold for the ITC and the PTC before prevailing wage kicks in is 1 megawatt AC. Anything smaller than that does not have to have prevailing wage. And again, that's the current interpretation of what we're going to see from Treasury. It is 5 years after facilities placed in service that the prevailing wage requirement does apply for any construction related alteration or repair. Let's talk about safe harbor. For those that that maybe not familiar with this, but safe harbor is basically a mechanism by which you can achieve start of construction either through a physical work test, through a 5% spend, etc. But basically, it's a way to put the line in the sand that you started construction. We've done it with 5% safe harbor in past projects, but basically it lets you preserve your place in line and not necessarily have to meet the prevailing wage if you do that within 60 days of Treasury guidance coming out on the prevailing wage side. So even if you aren't ready to start physical work, we can do the 5% safe harbor that helps preserve that lower costing for certain projects. And again, right now interpretations are that safe harbor guidance that's from the IRS over the last decade is not going to change, that will still apply for projects. Let's talk about the domestic content a little bit. So 2023 on domestic content gives you a higher tax credit on the ITC side. That takes that 30% now up to 40%, another 10% bonus on that. 100% of the steel or iron has to be from the domestic content. So again, all the steel and iron structural products have to be US made. The manufactured product requirement is at 40%. So 40% of equipment cost has to come in to hit that domestic content bonus, and that gets stronger still over time. There is language in there around waivers for domestic content and sort of a threshold if it increases project cost by more than 25%. Again, the waivers right now are going to be waivers to get direct pay, and we'll talk about that in a little bit, but not necessarily receiving the bonus. So I won't get a waiver and still get the extra 10% ITC, but I could get the waiver and still get direct pay for a project. Little nuance there that took us a while to tease out with a couple of law firms that we talked to. How much of that manufactured product to get there? Again, based on current interpretation, there is a threshold. So it's 40% of equipment costs for projects that start before 2025. That increases to 45% in 2026, and then increases every year thereafter. So 45%, then up to 50%, then up to 55%. Again, that is for if you're taking the tax credit as a credit. That's to get the domestic content bonus. You have to meet that minimum threshold. If you're taking direct pay, that's to get the full 30% tax credit. You have to meet some domestic content requirements. Let's talk about some of the bonuses based on where a project is sited. One is on energy community. It is defined as either a brownfield site, an area with historic oil and gas or coal employment and high unemployment, or a census tract where a coal mine or coal-fired generation has been retired. At the end of the day, we're all waiting for official Treasury guidance on this one. I've got 3 maps up here. You can see they're kind of very different on it, but sort of the worst case one, the left one that has the fewest amount, orange or dots where they're brownfields. They are specific sites identified by the EPA as brownfield sites. Light gray, dark gray are retired coal mines and coal plants. The dark gray is looking at a combination of those as well. And then we get into sort of that greater than 0.17% fossil fuel unemployment and higher than average unemployment, the red sections here. But there is a great swath of the country that is covered by that under, again, the most restrictive interpretation on the left. two other interpretations on the right, two different maps from two different sources, all have, very, very similar kind of characteristics. It is heavy on, West Virginia, Pennsylvania, Appalachia, as you'd expect. It's heavy on a lot of the historic oil and gas development activity that happened in California in particular, Texas as well, portions of New Mexico. But suffice it to say, there is a great amount of locations that are eligible as energy community properties. That gets an extra 10% bonus on the ITC. Low income has similar kinds of language on it. There's a 10% adder if it's located in a low income community or on Indian land. There's a 20% adder if the output of that system is basically going to low income residents. So think multifamily, low income housing, rooftop solar. I can get to the 20% adder. If I'm just siting a low income community, but it's going to a business that's located there, then it's a 10% adder. There are some limitations on how much of this will happen in terms of total gigawatts of it, but basically, this is here and this is now. So we're looking at a 10 to 20% adder, depending on where we are and how we're using that energy for low-income communities. Again, similar maps, lots of sections. It's down to the census tract level, so this is a pretty high-level map on it. But suffice it to say, a lot of what you would think of as low-income areas are going to qualify. Surprisingly, there are sections of, outside of certain major cities that are covered. So really, it is based on, physical address of the facility and what we're going to do with that and whether we can qualify for that low-income community bonus. Direct pay. So there is language in there that allows limit organizations to receive a direct payment of the investment tax credit. It's generally tax exempt facilities, including state and local governments, TVA, Indian government, Alaska Native corporations, or any kind of cooperatives, basically rural electric cooperatives, all qualify for sure. There's still questions on whether, say a 501c3 kind of tax exempt facility will qualify. We're not sure yet, but we expect that we'll have guidance here pretty soon on that. The direct pay is on a facility by facility basis, meaning that you can take it on each individual site. I don't have to say, at the rural electric cooperative level, every project we're going to do is going to be done. I can do it on each individual project site. It does have a floor of domestic content. We have a kind of short window of the calendar year 2023 where I don't have to meet domestic content, but starting in 2024, if I don't meet domestic content requirements, there is a clawback of some of that ITC. So, think of it this way: 30% investment tax credit on a base level for projects. Starting in 2024, if I don't meet the domestic content, it's not that I don't get the 10% adder, it's actually that I don't get the full 30%. So there will be a reduction in that if we don't meet domestic content. That gives us, as an industry, some time to do that. And that's the earlier comment about the waiver, that if it does increase cost by too much, you can get a waiver against that side of it. But right now, we're all expecting that we'll see more and more domestic content requirements from that. There is a gross up of the payment. Right now, it's a 6% gross up. So that 30% cash payment to you gets grossed up by 6%. I don't know the rationale for that, but I guess the government's spending our money easier that way. There is a transferability language on it that lets you transfer the tax credits to a third party, essentially to sell them, if you will, and not have that sale be a taxable event on your side. So as a project developer, we can bring in a tax credit investor that's going to buy the projects, and we don't pay taxes on that sale of it. It does not apply to tax exempt facilities, so a tax exempt facility can't sell that, but all for-profit entities that own projects can do that, and gives us the ability to let whoever's buying that carry that back 3 years and carry forward up to 22 years. So there is some ability to utilize that tax credit and bring in investors in a different way than we did before. I'll touch on this, not a thrust of what we're talking about, but there are advanced manufacturing production tax credits as well. Basically, manufacturers of products can now claim tax credits for clean energy components, basically solar, wind, and battery components. It does have some language in there, give you an idea of what it is, but it's, if you're doing thin film PV cells, it's like 4 cents a watt as a tax credit based on, however many watts you do. Crystalline silicon, same kind of thing, PV wafers, but suffice it to say, there are a ton of credits now designed to drive more and more onshoring of battery, wind, and solar manufacturing. We think that's going to continue to drive more and more manufacturers to onshore manufacturing. And we've seen some of the results of that already from some of the announcements over the last couple months. So really to kind of encapsulate all that, there are a whole host of new tax credits available for solar plus storage, and standalone storage. We don't have official Treasury guidance, but we have some really good interpretations from there. Our belief right now is domestic content bonus is hard to get to just because we have such limited suppliers. The area bonuses, low-income qualified energy community, are all really based on where the project's located. So that's a case-by-case basis. But really kind of guidance for everybody is the project basis can include some ancillary equipment. So as we're doing solar and energy storage at sites, let's look at ancillary equipment, things like EV charging, switchgear upgrades, et cetera, as qualified energy property. Take advantage of tax credits and do them all at the same time, similar to like we did with solar plus storage back in the older days. I'm going to pause there for any questions.
Perfect timing. I did have a question come in. How are you or we going to overcome domestic content on BESs? While majority
Battery
of
energy
cell
storage systems. Yeah.
There you go. While the majority of cell production is Chinese.
Yeah, I think, from an industry, if you hear Core's announcements in particular, Core's building their battery cell and module manufacturing in Buckeye, Arizona. There's a handful of others that are standing up cell manufacturing in the US. I think where we're all looking for is Treasury guidance on what exactly has to happen on the battery side. So as you guys may or may not know, but basically batteries kind of go through sort of 3 stages. One is the cells. So think of a AA battery cell. The cells are historically Asian manufacturers, Japan, Korea, and China. Those cells get stacked together into what are called battery modules. Those would be, sort of shoebox and bigger kind of size battery modules. And then those battery modules are put together into racks of systems and integrated into outdoor enclosures and things like that. Not yet sure on how much of that will have to come under the domestic content side, meaning that if cells are shipped from Asia to US and US does the battery module and rack assembly, will that fully qualify as US manufacturer or not? Again, we don't have great guidance yet. But we expect that'll come out here in the next 60 to 90 days on that side of it. Number one. So we are already seeing a heavy increase in cell manufacturing again onshore. I'd say the biggest driver is not this, and we didn't talk about it all, but the IRA does have a whole set of tax credits around EV charging, EV, electric vehicle manufacturing, including the batteries for it. So Altium in Ohio and in Michigan, LG Chem in Michigan, Panasonic's got another plant set up, but there's going to be I think there's like 5 gigawatts of capacity coming online in the next 12 to 18 months around energy storage. The vast majority of that's going to go to the EV market, but a lot of it's going to benefit us from an industry perspective for the stationary storage side as well.
There was one more question that came in. Is there an idea on the time frame of when direct pay would be received after a project is completed?
We know it's after project completion. We don't know yet timing. The guidance we're giving to customers is it's likely either 1 quarter or 1 full calendar year after project's completed. So again, kind of some range within there. We do know a couple banks that are already looking at finance options for customers around that. So they'll be able to do construction loan through receipt of ITC direct pay. But we're all waiting for official Treasury guidance on how quickly that will happen. Okay. Any more questions?
That's it for the moment.
Okay. Got it. All right. So let's walk through some case studies on what this really means from a project level perspective. So kind of a simplified example here, looking at a 1.25 megawatt DC roof mount array, a 1 megawatt AC kind of system, an install cost of around $1.65 a watt, or just over 2 million. Looking at sort of middle of the road Midwest numbers, about 1.6 million kilowatt hours a year, or 1,300 kilowatt hours per kWdc peak. Again, we picked solar only as a simple example, just to walk through. Batteries kind of really get into some very location specifics. We're looking on this case, in the case study we're looking at here, 11 cents a kilowatt hour as a grid power cost, increasing at 2.5% per year. Again, that's pretty conservative given what we're seeing over the last several years. And our case is looking at solar offsetting only 85% of those costs. So assumption is that we're not hitting 15% of the cost, whether that's demand charges or et cetera. But really solar is offsetting about 9.4 cents a kilowatt hour. And then we're going to look at scenarios, everything from 26% pre-IRA all the way through 60% with all of the adders within the IRA itself. As we look at these kind of left to right, starting with pre-IRA 26%, moving into sort of post-IRA 30%, 40%, 50%, kind of looking at different combinations of that. And again, you can get to 40% with domestic content only. You can get to 40% with low income only. You can get to 40% with energy community only, or you can get to stacking up into that 60% range. But basically, these all have a big impact on what that means overall to project economics level. As we look at these, it takes the payback down quite a bit. So kind of where we were pre-IRA to where we are post-IRA, IRR and simple paybacks improve slightly. 10 years goes down to 9.5 years. We're looking at a 10.3 to a 10.8% IRR. As we look at sort of increasing that over time or improving that, with different bonuses in their domestic content, low income, et cetera, that just really drives faster returns, better economics, and shorter simple paybacks. So the IRA is very, very beneficial for a project. Again, some of those bonuses we can only get if we're sited in the right area, but it does have a material impact on economics at a project level. Let's talk a little bit about the domestic content. This one looks at sort of two scenarios here. Left is 30%, right is 30% domestic content, but assuming that we're getting about a 10% higher cost. So, kind of question is if it costs me 10% more, but I get a 10% tax credit, is it worth it? Again, using this case study, it is. That higher domestic content does essentially pay for itself if it's only 10% adder. And again, we didn't run sort of sensitivity on this, but roughly 10-12% is about the break-even point. If domestic content is much more than that as an increase in cost, it's probably not worth it. But at this range, it does still support it. We still have a better simple payback, better IRR. With domestic content at 10% higher cost than non-domestic content side of it. Again, hypothetical, we're all kind of competing for the same suppliers on the domestic content side, but there is a trade-off that we're always looking at to see if it is worth going after that as a bonus to get into there. When you guys get the deck, you'll see this. There's a full sort of simplified model behind all this, looking at all those examples and sort of showing you the details of how you calculate it. Feel free to check our math, if you will, but it is a good simple example to kind of look at this on an IRR basis. We only looked at upfront cost, investment tax credit, and cost savings at that 9.4 cents a kilowatt hour, 85% of power cost. Did not factor in the benefit of accelerated depreciation. And again, this doesn't factor in O&M costs on this as well. So again, it's a good simple example to look at what this looks like on an apples to apples basis, looking again at the returns under a whole different set of ITC regimes. Questions? No? Okay, all right, moving on. So kind of just to kind of where we are now, we and Centurion are part of your solution set. Really our approach is to understand where you are today, baseline your current electricity usage and costs before we really look at those options. And then we layer in things like solar energy storage and related technologies to lower your cost, stabilize your energy costs, giving you known cost for the next 25 plus years on these, and leverage those tax benefits to get you to the right economic value prop for your facility. Again, contact us. We're happy to help you guys with your customers or with your facilities directly. A couple sources for you guys: ACP, American Clean Power, and SEIA both have some great resources. I put a link in there to our website. If you guys want to get started with us, fill out the form or contact us directly, and we're happy to help. And I think that's it.
One more question. I'm sure you've already been calculating some of these returns for your current client base. Have there been any shocking numbers that have kind of jumped out at you?
I'd say, really kind of where a lot of our projects are at today are in that understand the impact of prevailing wage and whether they can contract fast enough to not have to go to that. So some things were priced prior to prevailing wage and apprenticeship requirements. There is a likely cost adder to get to prevailing wage and apprenticeship requirements for some of those, particularly if they're open shop. So that's one thing we're looking at on certain projects. No big surprise there, but we knew that was going to be an impact. And some of those are doing that trade-off to contract fast, to get the safe harbor so that happens without having to go the prevailing wage. I think the surprise on us is how hard the domestic content requirement is right now. Again, we all knew it was a challenge from an industry. On the module side, it's Helene, it's First Solar, it's Jinko, it's Hanwha Q cells that are making in the US. And they're all commanding a premium, and that premium's kind of gotten a little bit higher as they've gotten, more and more developers and project EPCs chasing them on things. So I'd say the domestic content higher cost was a little bit of a surprise. It wasn't as much of a premium, but it is because there's just a tight supply on that side of it right now. I'd say really the bigger surprise to us has really been how much of the country, again, strict interpretation or strict likely language around the ITC and the Treasury guidance, how much of the country is falling under qualified energy community, how much is falling under low income areas. Those are some great bonuses that are really helping drive project costs down. I didn't talk about it in this presentation, but we do work with a number of finance partners. So the majority of our projects we've deployed to date have been under a power purchase agreement or a solar lease kind of agreement. Really what happens with the investment tax credit, higher tax credits just mean I can hit the investor return with a lower PPA rate. So we're seeing cost under a PPA really decline as we get to more and more higher ITCs.
Awesome. Thank you so much, Scott. I thought that was extremely beneficial. I know that there's been a lot of questions and correspondence in the chat. I'm going to be putting everything together and sending everybody out a follow-up. So thank you, Scott, so much for hosting this today. We've kept you for about 47 minutes, so we appreciate your time very much. And I think this has been really enjoyable and eye-opening. So we wish everybody. Thank you. Thanks, Craig. Thanks, Scott.
Thanks, everybody.
Have a great day.